Hi friends, welcome to Dhiksoochi, driven by passion and values. Today we are going to learn risk and return with Dr. G. Sabitha. What is risk and what is return? Risk and return are very important concepts in every individual life. You may be a student, you may be an entrepreneur, or you may be an employee. You must know what is the risk you are bearing it and what is the return you are expecting on it. Risk and return, both the concepts are very important to understand, and let us see what exactly the risk and return are and what is the relationship between risk and return in this video. So, let us talk on concept of risk. So, what is the concept of risk? Means, if you see this picture, see, there is a person who is driving a crane and there are two people who are standing under that crane and talking to each other. And there is an unfortunate situation which is going to be happen. Can you see this? So, a brick is going to fall. It may hit the person or it may not hit the person. That is what the risk is. Means the risk is unexpected event. The risk is unexpected event. So let me write that. Unexpected event. Simple. This is what you need to remember. So this is generally you can understand what is the concept of risk is. Of course, the subject also define what the risk is. As per ISO, International Organization for Standardization, what the risk is. So if you want to define the risk, that is combination of the probability of an event and its consequences. That is what the risk is. So let us see the concept of return. Once you know the risk, you also have to know the return. Then we can talk about the relationship between them. Then, if you see this, every time, every individual is going on using the calculator to know the amount what they are going to get it, or to know the marks how much they are going to get after writing their examination. So, this generally the return is what you are expecting after a particular process or after happening of an event. That is what the return is. Return also defined. That is, this is a change in the price of an asset. The price may increase or the price may decrease. Whatever is happening, that is the return. So, how the risk is in positive and negative, same way the return also positive and negative. So, risk was talking about the unexpected event. It may be favorable, the event whatever is happening is a favorable, and it may be unfavorable. Same way, the return, whatever you are calculating, may be acceptable or may not be acceptable. So, the return is the change in price of an asset or the change in price of your investment, or sometimes it also defines that the time how much you are taking to complete a particular project. So that is what the return is. So how, if you want to see exactly, want to understand what exactly the return when you are working on a project, whatever the ideas you are taking, understanding, and whatever the plan you are making is all the risk what you are going to take to complete that project. So because of this risk, the project may be completed within a short duration. That generally we can say in a return. These are generally the theoretical concepts. So when you come for the quantitative concepts, first we have to know what the relationship between risk and return trade-off. That is the relationship between risk and return. Of course, the risk, higher the risk, higher the return. Lower the risk, lower the return. So, if you see this diagram, you can understand that. So, yes, risk and return are directly proportional to each other. That is, higher the risk, higher the return. Lower the risk, lower the return. So, that is what the relationship between risk and return trade-off. If you are ready to take higher risk, then you can expect the higher return. Example, if you are a student, you are working for longer hours, you are studying for a longer hours for a particular subject, you are working on a particular concept, then If you get the same question in the examination, then you are thoroughly writing that answer. That is what the written. So written in the sense you are going to get a good mark in that. That is what, how much effort you are putting on, the same the result will be. If you are studying a particular subject thoroughly, then you can expect the 100% marks. If you are not studying, if you are trying to get only pass marks, probably sometimes you may fail. That is what the relationship between risk and return, that is what the relationship between what is the effort you are putting on and what is the return you are getting in your examination in terms of the marks. Same way, if you talk about in the investment means it is related to one individual who is an employee or who is an entrepreneur or who is an investor. So there they wanted to understand the concept of risk and return. They must know that if they take higher the risk in their investment, then they can expect the more return. Right? So let us see what exactly the types of investments are. Of course, there are different types of investments. So once if you start doing your business, or you have got an employment, or you have got a pocket money more and more and you wanted to invest somewhere, so most of the individuals will look for bank investment first. Then of course every time whenever you get some kind of a progress, then every student or every child or every employee want to buy a particular bike or something else. So whenever they buy a particular bike or car, they have to go for insurance. What is that insurance is? What you are taking that insurance is to hedge your risk. So obviously the other investment of any individual is definitely an insurance. Also, still furthermore you wanted to invest somewhere, you may go for investments in bonds, you may go for investments in mutual funds, or you may would like to invest in share market. Few may their business itself is the real estate. Few would like to buy some gold, some ornaments. So these are the general types of investments what a common man or an individual, maybe our parents, if you see our parents or any employee is going to invest in it. So if you want to invest in a bank, what kind of risk we are bearing in this? Obviously there is no risk at all. Let us define them, risk and return based on their investments here. Because once they invest in the bank, they can forget about their investment risk. So the return also the same. Return will be fixed by the RBI or maybe a particular bank, and they are going to give you a particular return. So that is fixed. So when we are talking about it is fixed, and definitely it is little. So lesser the risk, because there is no risk at all. Lesser the risk and lesser the return. Same way if you talk about insurance, of course there is no risk. You are taking this insurance to hedge your risk, but exactly the risk is not involved. You are not going to meet with an accident because you have taken an insurance, right? So we obviously can say there is no risk in insurance at all. Of course the return also, there is very less return in the insurance investment. Bonds, even bonds, there is no much risk, lower the risk, so lower the return. When come for mutual funds, of course you will be hearing that. What is that? Investment in mutual funds are subject to market risks. So if there is a risk, you are getting a return. If there is a higher the risk, then higher the return you are going to get it. And next you are talking about the share market. So what is this share market is? Everybody knows. Within a second, the price may fall down like anything. Within a minute, the price may come up like anything. So higher the risk, and you also have higher return over here. In the share market, the risk and relationship is obviously quite exactly what you are going to talk about, the relationship between risk and return. If you invest less, less amount, then your loss is very less. If you invest higher amount, then means you are risking the higher amount, then your return also high. Then real estate, of course, if you invest high, your risk also high. If you invest less, your risk also very less. Gold, price may come down, price may increase. Same way, the risk and return also define. This is how generally the risk and return involved in investments, different types of investment. Let us see the same thing on a simple graph which was taken from Google. So see here, if you see this money market, government treasury bills, all these are riskless assets, because of which there is lesser the risk and lesser the return. Right? So next you are going to talk about the corporate bonds which are issued by the corporates for an individual. Of course, I am planning to give some more videos exclusively on money markets and corporate bonds and share market, blue chip, under that again blue chip, small capital and other high risk investments. So those will be discussed in the further slides, but at this video, in this video we talk about only the relationship between risk and return. So if you invest in a corporate bonds, so little higher the risk, because these are the corporates. There is no government guarantee over here. Same way you get little more return on it. The third one is blue chip. Blue chip means it is a large cap equities. Of course, large cap means if even it increases by 1 rupee, it is going to give you a higher return. So this is what the risk return relationship between the relationship between the risk return related to blue chip investment. Same way, there is little higher risk in small cap comparatively with the blue chip. Also, little higher return in the small cap investments comparatively with the blue chip companies. And next one is high risk return potential equities. In this equities, highest risk means if you invest 100%, you may get 500% return, or you may lose all 100% return on this. This is how we can define the relationship between high risk and high return when you are talking about high risk and return potential equities. So this what? So finally what we can say it is, if you understand, not only this, see, it's not graphically I have given you the explanation. Even if you observe any kind of an investments, you can do mock survey on that, mock investments on that, and you can understand what is the risk and return involved in it. So if you are ready to bear the high risk, and definitely it is going to give you high returns. If you are not want to take high risk, that is if you are risk averse, then you are going to get a lesser return. So that depends what kind of investment you have to choose, what kind of efforts you are putting on, all depends on your interest of taking the risk. The return also depends the same, risk return also for in the same manner. So that's what for today, friends, and let us see with some more videos in the future videos. Let us meet with other topics in the future videos, and I hope you understood what is the relationship between risk and return. Before that, what is the concept of risk and whatever the concept of return. Further, if you want detail of definitions of risk and return, so on your suggestions, on your request, I may plan to prepare few more videos exclusive on return and exclusive on risk. So for the day, thank you, bye, take care, bye bye.